Okay, today I wanted to actually take you through a topic from one of my recent reports. What is the weekly macro themes, which is this report here? It is one of the flagship reports of my institutional service, but you can learn more about that on your own time. Anyway, look, there's five very interesting topics here. I could easily do a video on each of them and talk at length, but the one that is probably of most interest and certainly relevance would be the China macro topic from number one. So we'll look at this now and we'll go straight to the bottom line. Given softer core inflation, a weak hard data pulse, and likely further slowing of property price growth and the virus impact, expect more monetary easing by the PBOC. And that's basically the bottom line. If that's all you wanted, then you can turn off the video. If you want to see the charts and the logic and the thinking behind it, then stick around. So first of all, let's cover off some recent stuff here, recent developments. The chart on the left here is the China benchmark interest rate. I've actually substituted in the LPR changes from August, which is when that rate was introduced. It's the loan prime rate. It's basically China's new policy rate. They set it on the 20th of each month, so definitely you want to be marking that on your calendar because that's basically one of the world's most important central banks. Actually, I think you could probably argue it's the most important central bank. Um, certainly giving the Fed a run for its money on that front. So make sure you mark that on your calendar, the 20th of the month. Now, but this month, so we did get a 10 basis point cut, which is about what people were kind of expecting, and that was after a pause of a couple of months. But it wasn't really a surprise because, earlier in the month, a bunch of officials from the PBOC were talking about what they could do and how they probably will cut rates and all the rest of it. And also they cut the MLF rate, which the LPR is supposed to be linked to. The MLF stands for Medium Term Loan Facility. It's basically a way of funding the banks, or giving the banks cheap funding. It's almost like the TLTRO that the ECB used to be doing, and or you could call it a form of quantitative easing. Anyway, that rate is another rate to keep an eye on. And I think probably most of the time, if they're going to cut the LPR, then they'll probably cut the MLF either before or simultaneously. Anyway, the point is that's dropped again, and that's probably the start of things to come. And speaking of the start or sign of things to come, the chart on the right here gives you a pretty blatant and clear to see insight in terms of what's triggering that. Obviously, we've got the virus outbreak. I'm not going to go into detail on that. You've probably heard more than enough on that, and you're probably well up to speed on that already. But this here chart on the right, the black line is the Ipsos Consumer Sentiment Survey for China. That comes out around the middle of the month, so that was actually the first piece of data that we got. I was talking to clients about this earlier. It comes out earlier than the SMI, which some people have started to talk about. But anyway, yeah, it's clear that the data is going to show a big decline. But I always think when it comes to stuff like this virus issue, or any other kind of geopolitical risk or event risk or political risk, some sort of thing that you really can't forecast. You could muse on the possibility of it and then in hindsight say that, oh, look at that, I predicted that. But it's really something that you can't really predict. So you have to go back to first principles. And what does that mean? It means what are the actual underlying trends and realities that we're dealing with, because then you overlay that issue or event risk and you say, okay, now what does that mean? Does that negate it? To what extent would it negate it, or does it offset it, or does it enhance it, or does it change? Does it derail the existing case, or does it add to that case? And in this situation here, we've got to focus here on these two charts on the right. So the one up the top there, That is what I've called here the hard data growth indicator. That's basically a summation of the growth rate of the hard data series for China, all the main ones. And you can see there that it's at a cyclical and structural low. Obviously, there's been a structural trend lower there, and you know, there's a lot of well understood things going on behind that. I won't go into detail on those, but cyclically, China had actually been going into a bit of a slowdown there already. So, from a hard data standpoint, if you're a central bank who engages in counter-cyclical macroeconomic policy, then obviously at this point you would be looking to offset or help turn around that data pulse there. So that's one side of the coin. The other side of the coin, obviously, for the majority of central banks is inflation targeting or inflation awareness. I think probably just about 90% of the world's central banks are at least inflation aware, if not inflation targeting. And if you look at the China inflation indicators here, so I've got here 4 of my kind of favorite ones to keep an eye on, and I've put them in a Z-score to keep them on common comparable terms because there are slightly different levels. It's year-on-year change. So the one that is probably the most inconvenient one is that red one there, which is going up. That's because of pork prices, and that was actually due to a different virus, which was a virus called the swine flu, and that was decimating pig populations in China, and so they're already still dealing with the aftermath of that. Um, you know, a lot of central banks do tend to look through that kind of inflation, but obviously you're still conscious of it. In the background, though, you've got property prices rolling over. Core CPI had rolled over; it's stabilizing a bit now, and core PPI running at a fairly low pace as well, actually running at the same pace as back in 15-16, which is where they did actually undertake a bit more forceful stimulus. So really, what does it add up to? It adds up to the data pulse was fairly weak already. Inflation, for the most part, core inflation and the inflation that matters most, property price inflation, was rolling over. So, under normal circumstances, you'd say that the PBOC would basically go ahead and ease policy. Now, just briefly picking up on that blue line, because I've got a couple of charts here on it. Property price growth has been slowing quite notably in recent months for China, and the main reason for that is basically macro-prudential tightening, previous tightening, and that's basically kind of starting to get underway now, that weakness there, and you can see that on the month-over-month changes there, basically half of cities saw a decline in property prices in January. So this is data up to January. And you can see that a growing proportion of cities are actually seeing negative year-over-year growth rates in property prices. And for the most part, when property price growth rolls over, it tends to keep going, and so it turns into a bit of a mini downturn. They tend to be quite active. China tends to be quite active in managing this cycle, so this is actually a really useful indicator for getting a good read on the macro policy outlook. But back to the topic at hand. It brings us finally, I guess, to the stimulus indicators chart, which shows you in the black line there, that's the fiscal impulse. So yeah, they had actually been doing, quite a bit of, or sort of slew of fiscal measures last year. So tax cuts, infrastructure, subsidies, the usual things, and but it was not really enough to offset the impact of the trade war and the global export manufacturing recession that we saw really intensify into the later months of last year. And but they had in the meantime, they'd been really holding back on monetary policy. And as I noted up here, that where is it? I've got an interesting line here, controversial line maybe. There remains a reluctance to ease, with a sort of almost irrational phobia of repeating the 2009, you know, excessive stimulus, which I think the consensus among the party there now was that it was basically a mistake. So there is that sort of fear or inhibition holding them back from doing the same kind of thing. You know, what the virus shutdown does is accentuate these trends here. So back to what I was saying before, first principles, well, the underlying trend is that we saw hard data was looking cyclically and structurally weak. The core or the most important inflationary indicators were already rolling over. Property price growth, basically, my favorite macro indicator for China, rolling over, getting worse. Surely the virus impact is going to make that worse still. And so, yeah, plopping that virus stuff on top of this, it makes the case fairly clear that it should be a situation of when, not if. And the only thing to think about on that if side of things, if they really do decide to actually decide, well, we'd rather not risk blowing up bubbles any further, would rather not risk pushing leverage any further. If they decide to go down that route, it could end up actually being a bit of a, well, not a bit of, it could actually be a substantial policy mistake, and basically a, an unforced error, I guess, as you could call it, and that's basically the bottom line. Given softer core inflation, a weak hard data pulse, and likely further slowing of property price growth, add to all of that the virus shutdown, and the virus risks because this is kind of those first order impacts, right? Which is what we've seen here in the China Consumer Confidence Index, the private index there. That's another thing to notice, that Ipsos one is a private one. It comes out in the middle of the month. The MBS one is the official. That one comes out with quite a lag, so that's only updated to December there. So we've already seen the direct impact in China of the direct impact of the virus in terms of shutting down activity within China. But then there's probably going to be this, global sentiment impact where you have it impacting negatively on external demand, which kind of even more will accentuate it and even more makes the case for further that this 10 bip cut is the first of many to come. And in terms of implications, obviously, that's monetary policy in China is absolutely critical for things like commodities, emerging markets, and I think just general global risk sentiment. So, yeah, pretty key topic here, and certainly one to keep a close eye on. I would, personally, I'm keeping a closer eye on this sort of data than the virus count data. I'll, as I said this here, I'll leave the virus tracking to the experts and stick to what I know. And this is what I know. So there you have it. If you like this video, you should subscribe to the channel.